One of the signatures of the tariff tantrum was the sell-off in the dollar amidst a weakening of the back end of the yield curve. Terrible, right? It's a Liz Truss sort of 2022 period of the guilt crisis.
Do you agree with the market that President Trump has moved on from tariffs?
I do. If you're in the single stock land, and most people have that type of exposure, not a bad time to think about a little bit of rainy day insurance. The market's kind of handing it to you. Bitcoin has gotten to a new breakout level. Once it finds a way to punch through, it can really get to a new high level. And now it hasn't yet. We've been really trending right around this 108, 110 level. But I find it super interesting that the market gives you an opportunity to buy calls and call spreads at historically extremely low levels, when the history says that if we do get through 110, it could be a little bit of an off to the races period.
Very pleased today to be joined by Dean Curnutt of Macro Risk Advisors and the Alpha Exchange podcast. Dean, I'm so glad you're here. Welcome to Monetary Matters. My first question for you, Dean, you're an expert in volatility and trading, but you follow everything, stocks, bonds, the whole 9 yards. Dean, you've collected a few sayings, you call them pithy sayings about the market. Which of them, if any, apply to the market that we have right now?
Yeah, so Jack, thanks for having me on. It's exciting to be with you. And what I would say is I've been doing this for quite a long time, kind of 35 years in the markets. And for me, at least, I try to learn from history. And I'm not a super organized guy, so I tend to try to create little shorthands that help me sort of think through the world of market risk, things I can come back to on a repeated basis that help me understand the world of risk. And so I developed what I call 25 sayings on vol and risk a couple of years ago, and I recently added 10 to it. So I'm at 35. Maybe I'm working my way towards a book or something. But of a couple that I recently added, there's two that I think fit right into your question. And so the first one I would say is what I say, realize vol rules the world. And what I mean by that is that really everything in market pricing, especially in the options world, is a function of the day-to-day swings in the underlying asset. And what I mean by day-to-day swings is the sort of the extent to which there's volatility on a daily basis, and then more recently, the extent to which there's not volatility on a daily basis. When we think about the decisions we make in markets or even in life, those are very much a function of how fast things are moving. They are a function of our experiences. And so when we wake up each day, and especially recently, I'd say the last 2 months, really, it's kind of like watching paint dry in the market. The S&P has not had a 2% move in, I think it's about 2 months. We're rarely even getting 1% moves. And so without that daily action, when you look to implement option strategies, it's really those daily moves that motivate you to think about things like hedging. If you're thinking about buying an umbrella and you wake up every single day and it's sunny and blue skies, you just kind of lose interest in buying the umbrella, even if its price gets cheaper. And so what we're seeing in the markets, especially, we could think about April 9th as the starting point. That's the big climb down from Trump. The VIX got to the low 50s in the days before that. And it's been, kind of on a one-way path down to 16 here. And what's really forcing that to happen, that compression of option prices, is really a function of the lack of daily swings. So realized vol rules the world in the sense that a 10 realized volatility level on the S&P, which is what it is over the last month, it's just not enough to motivate people to pay a lot for options.
So volatility is how much things move. Realized volatility is how much things have moved in the past. Recently, implied volatility is what is the options market pricing in terms of how much things moves, and they are quite correlated. And so Dean, in the stock market, when things go down, they tend to go down a lot. So volatility, high volatility, is often a synonym for a crude synonym for the market crash, or the market went down a lot. And we saw that on April 2nd, Liberation Day. April 9th was, I believe, the bottom in the stock market, but the top, what you were referring to, the step down, I think was in volatility, or the VIX, which is basically, a form of a 30-day implied volatility on the S&P. And volatility, yeah, what happened in April? And as someone who very attuned to the options market, just how did you experience that? I'll share my framework. Perhaps some people have experienced it my way going in. I'm just shocked at how big the volatility was. What I noticed was that the VIX went up a lot, but there was a time where the VIX futures curve was quite backwardated. So the market was pricing like things would go in, but the market was just moving. I guess it was only for a few days, but the market was moving so much that even though implied volatility had risen, realized volatility was still way higher. And I was paying attention to tariffs, and I thought that I was watching the main stage, but maybe I was only watching the shadow puppets, and there were other stuff going on. But somehow, people in the market were aware much before I was, even though I was paying attention, pretty much every second, of just that tariffs did not have as much teeth as Liberation Day Trump came out. So just walk us through how you experienced Liberation Day and the few days after that, and then coming up until now when we've just been grinding higher and higher. And by the way, Dean, there were very, very smart people on Twitter who, like trade vol every day, who at on April 4th or April 5th, they said, there's no way we can get to all-time highs within a few months. The hedge fund leverage community has just been killed. Realized volatility is too high that the hedge funds, the multi-strategy firms, their risk limits are going to be cut for a long time, because on a 90-day look back, realized volatility is still too high, so they can't get involved. And I know that goes to your thesis about how crises build, and the market goes up very, very slowly until a sort of a Minsky moment. So yeah, I know I threw it a lot at you, but April 2nd, go.
Yeah, I think the first thing I would say is, if you sort of think about the market vol events, how and why do they occur? To what degree do they occur? My first statement would be, it's a shattering of a consensus. The market has a view, and of course, the market can't predict the future, but it's trying to do its best to price in, the state of the world that it believes is true. If we think about the largest market vol events, they are kind of some collision with the shattering of this consensus. And I'll throw a couple at you just to bring in some history, with positioning. And positioning and a consensus are often very related. We position forcefully into a view depending on the strength of the consensus. So here's two I often use, and I just reread The Big Short, just to go back through it. And I'm watching the movie with my son Liam, who's interning for me for the summer. And so, best to teach people about markets and through analyzing periods where things go horribly wrong. The consensus was certainly that subprime is contained, that housing prices can never go down on a national basis. And there was this just gigantic industry of leverage built around that assumption. And so when it turned out to be very wrong, that's when you get that collision where prices have to adjust remarkably. The 2011 sovereign crisis in Europe was another example where we were just taught that a developed market sovereign can't default. And that turned out to be really wrong as well. And so what I would say about Liberation Day is Trump surprised the market. He was talking about tariffs for months. So yeah, of course, there was some expectation that things were coming, but the extent of it was just entirely in a different stadium, than the market had believed. And so what you saw was just a gigantic reaction on April 3rd and 4th. They were effectively consecutive 5% down days. Now, again, realized vol rules the world. So my option prices were assuming that the S&P was going to move kind of 1% a day. That's a 16-ish vol. And suddenly I get 5 times that on consecutive days. We have shattered the consensus. The vol regime that we thought we were in is entirely different, and prices need to move very, very quickly. So the VIX skyrockets by Monday. After thinking about it for a long weekend, the market got even more worried. And by Monday, the VIX was in the mid to high 50s. And so it's a very, very different regime in a very short period of time. Think about just the reinforcement of risk back into the system. Folks that, let's just say, had sold puts, very common strategy to earn some income, and they sold them at a price associated with I don't know, a 20 implied volatility, and now the market's at a 50 vol, you're losing money very quickly in two ways. One is the delta moved against you. The market went down almost 10% in 2 days, or maybe more than 10%. And then that vol jacked up by 30 to 40 vols. And so that double whammy on the people that were long the market and short volatility, it's a reinforcing mechanism where you had pointed to the value at risk on people's sheets just explodes. And so there's a lot of pricing in the market, or a lot of risk taking in the market, that's very just contingent on value at risk. And so you get this de-risking process that can feed into itself in a reinforcing way very, very quickly.
So that value at risk is basically what's a 1 in 100 day, what's the most I could lose? A 5 in 100 day, what's the most I could lose? Those, I think, were used improperly maybe during the great financial crisis because they were on like illiquid credit products. But I think, a lot of hedge funds use them, probably all hedge funds use them, and they work out okay. Okay, but so Dean, tell me more about, and why do you think that the market snapped back so suddenly? It's like a rocket ship, almost like, obviously the crash was nowhere near March 2020, but the violent upsurge maybe could be compared to the violent upsurge from the bottom in, I believe, March 23rd, 2020. Why has the upsurge been so strong, and what has happened to the options market? What are you seeing that confirms that or shows that?
Yeah. I think what was so unique about this was one, that it was wholly self-imposed. It was Trump deciding, and maybe with Scott Bessett and maybe throw Navarro and Lutnick in there, but they came at us in the marketplace and the world with just substantial numbers that were, really improbable to actually execute. Maybe the market knew in the back of its mind that, these would be ultimately unworkable. Best insight I had was on April, I want to say 5th. That was the Monday, maybe it was April 6th. But you saw the VIX in the 50s, and you just knew that, looking at the history of financial market dysfunction, which is really what I study, GFC, sovereign crisis, flash crash, the COVID crash, the precedent for a 50 VIX is a very unwelcome precedent. It's 50 on the way to 80. And that was GFC and COVID. And that was with a ton of government intervention. And what else did you throw in that sort of emerging contagion bucket? Was obviously the swap spread widening. There was a lot of discussion on the basis trade. The bond market was not doing what it was supposed to in terms of being a risk off asset. It was, in some ways, I don't want to say amplifying the risk, but it certainly wasn't providing the opportunity for folks to get out of the stock market into something less risky. You saw a very rare thing. I want to say the 2-year rallied in by 10 basis points. So the yield went down by 10 basis points, and the 10-year went up by 10 basis points. Very, very rare to see that, and a very bad sign. It's telling you that the back end is unstable. And so, again, to me, just knowing that the authorities will cry no mas. They will always try to intervene. And frankly, as they ought to, you can create problems that are so difficult to undo if the financial fire grows out of control. You can spend a lot of capital and a lot of time trying to put that fire out. That's really what the 6 months from September to March, September '08 to March of '09, that's what that was about. The all day and all weekend summits in late 2011 in the Eurozone try to put the fire out. It's very difficult when the markets run out of control. And so, for me, what was so unique about this and different was that it was easy to undo. And it just, I think, took a couple of days for Besant probably to get calls from his, friends in the hedge fund industry saying, look, you've got a real problem brewing here. You could take whatever metric you want. It could be swap spread widening. It could be my VIX of 50 on the way to 80. But you just knew that even Trump, who's totally capable of just backtracking, right? He sees something, he doesn't like it, He said the bond market got the yips. And on April 9th, he undid it. And so you saw this massive decline in the VIX, in swap spreads, the things that were the center of the storm that he had very much control over. Just say, hey, look, let's put this on a 90-day pause, and that will give us some time. And then the contagion that was brewing in financial assets, he could put that at bay for a period of time. So that's obviously what's occurred, and it's continued. I think the market's losing its beta to the tariff concerns at this point.
And Dean, that 90-day exemption was announced in early April. That was the day the market rallied 10%. 90 days after that 90-day exemption was July 8th or July 7th. And now we're a few days after that, average recording in July. Now Trump has extended those into early August, and he's written letters announcing essentially new tariff deals. He's calling them deals, but they're basically letters. They're not deals. So now the new date is August 1. So how I found it very challenging because I don't really know what to grasp onto. It's kind of like I'm in a jungle gym and I'm doing those bars where you're going up that, but it's instead of like the bars being made out of metal, they're made out of like butter. It's just very hard for me to grasp what's going on. And like during a banking crisis, it's okay. You look at the bank's annual report, you look at their investor presentations, you look at there's data to look at. Whereas now it's I'm like, what do I do? And I can't imagine, Dean, what are you and your clients who are very sophisticated hedge funds and traders, are they in the same position? Like, are they going back and reading books and stuff about like tariffs in the 1900s? Like, how do you trade when so much is based off of the whims of one man, the president of the United States, who has been quite clear in his vision of tariffs, but in terms of his implementation, he's one day extremely tough, and the other day he's announcing tariffs that have far less teeth, and he's delaying. And that is why basically the markets rally so much, in my opinion, is because he's just delayed. So how do you and your clients make sense of this? And any wisdom and insight you could share would be very valuable. Thank you.
The first thing I would say is if you go back to Trump of 2016 into 2017, glued to the S&P 500, that was his scorecard. And, very uniquely, 2017, which was forecast to be a year of absolute chaos post-Trump winning, was the lowest vol year for both stocks and bonds in 50 odd years. You got to go back to the 1960s to see something as stable as the 2017 market in the S&P 500. So, clearly the person at the center of it all doesn't always create the volatility, but it's hard to argue that 2025 he wasn't the source of all this volatility. I was struck by, again, thinking that he prides himself on the market outcomes, that he was willing to watch the S&P fall as quickly and as decidedly as it did. Of course, he started to say it was Biden's economy for a period of time, and now he's worked out of it. So I think some of his attention switched away from tariffs. I think he realized I'm not going to get as much done as I thought. I probably like having the S&P up at an all-time high again. I want to get my one big beautiful bill done. And I think the market is reading it, basically saying, look, the financial response to tariffs, which was really all about April 2nd to April 9th, this is a market reaction, is probably now more of a economic and inflation reaction. In other words, some argue that tariffs will ultimately put upward pressure on the metrics that the Fed cares about. Certainly that's the Fed saying that they want to be cautious around that. Some of the data doesn't really show up yet in some of the metrics we look at in core PCE and so forth. But the financial market reaction, this is back to your point about April 9th plus 3 months, that has kind of come and gone. And, the VIX is at 16 here. And I want to talk about the vol risk premium. But July 8th or 9th came and went. The market really didn't do anything. I think Trump has largely moved on. And I think the market has largely believes that as well. Now, we should never discount the ability to be surprised. We saw the copper stuff, right? But back to my, everything's about pricing off of realized vol. Well, the S&P isn't doing much. So people aren't in a rush to hurry to hedge. And yet, if you look at the VIX is at 16, that's 6 points above 1 month realized volatility. We call that the vol risk premium. That's pretty high. That's a decent insurance chunk. And then you actually have to look at not just the VIX, but look at VIX futures.
Mhm.
August VIX future is at 19 and a half. So that's almost double 1 month realized vol. That's a very high premium. That's in the 95th percentile over the last couple of years. That spread is extremely high. And so there does seem to still be a little bit of uncertainty premium. There's always a little bit of a spread between implied and realized. That's what motivates the insurance seller to get out of bed in the morning, try to earn that premium. But 9.5 vols is pretty high. So I would argue that there is still, amidst this very low realized vol, there is still a little bit of premium. Maybe it is tariff uncertainty out on the horizon.
So the vol market is still alert, even though implied volatility is way, way down. It is well above realized volatility. So there is a volatility risk premium. But if you look at the S&P, the stock market is at all-time highs, even though the announced tariff rates that President Trump gave in those letters that are set to go in on Schedule 1st, 25% on South Korea, 25% on Japan, 40% on Myanmar, 30% on South Africa, 40% on Laos. Those are quite high tariff rates, and those are tariff rates that certainly 4-5 months ago the market would have considered extremely bearish scenarios. But I've been saying that the real art of the deal that President Trump has been doing is with the stock market and in the general public of announcing an 140% tariff, and therefore a 30% tariff sounds low, even though originally, no one would have considered a 30% tariff quite low. So do you think that the stock market believes that these 40, 25%, 30% tariffs are going to be implemented on April 1st or August 1st? Or what do you think the market is the market pricing in basically a capitulation from Trump, just a constant rolling? It's like a 90-day calendar. It just rolls every single time. And there's always some super scary tariff in the future that never actually comes. Is that really the belief of the stock market right now? What do you think?
I think it's more that. Yeah, I think he's rolled it a couple times. China was obviously the big deal here, and he's kind of rolling that one. We'll see where that exactly goes, but I do think the market's kind of conditioned itself to, they call it the taco, right? Trump always chickens out. These things have just not proven disruptive, and I do think that with the market at this all-time high, he just got this bill passed. I think his motivation is more to let these things go. I don't think it's front and center. He tried it. He's realized it's extremely difficult. I'm sure even he didn't love the disruption to the market. Maybe guys like Besson, who obviously knows a ton about financial market plumbing, are advising him to be more cautious on this front. And it is a reminder of what we saw in the trade uncertainty period in 2019, his first presidency, which is the market's beta, its reaction to the headlines. It got dulled over time. The first one was the biggest, and then it got dulled over time. You saw this even with things like the interaction with his bestie Kim Jong Un in North Korea. I mean, I'll never forget. The VIX was at 11 in August of 2017, and it went to 16 in one day, which is a gigantic move on a percentage basis from a very low vol to something still low, but a big move. And that was one, on the my button is bigger than your button. And then it just dulled out. The market just sort of stopped focusing on it. And I think that's kind of where we've gotten to.
Yeah, that is interesting. And do you agree with the market that President Trump has moved on from tariffs?
I do.
Um,
Now, again, I'm a never say never guy when it comes to markets. Again, using copper as an example from yesterday, he clearly still has the capacity to move markets. That we always have to be, careful of. And I think what we're supposed to do is look back on what occurred in that period and try to see, okay, is there a playbook we're supposed to be ready to draw upon? And we should take certain lessons away from that, again, that period. One is clearly we do need to be on the lookout that vol can go from something very low to very high. I was just reading an article on Bloomberg today about the consumption of selling CDS, which is a form of selling vol. You're earning carry by essentially going long, long bonds, and that's a short vol trade. And that trade's gotten very big. Credit spreads had been very, very stable for a very long period of time. The IG index was at 45. It doubled to 90. It's back to 50. So those are the types of things we should look at and say, okay, are there ways to put reasonable carry trades into the defensive side of the portfolio? You do need to spend money to get insurance. The folks that are running around telling you they've got the zero carry insurance trade, I don't think that's intellectually honest. There's just not, those just are not around. Now, for a long period, especially post the GFC, the Treasury market did in some ways offer that to you. You had a positive carry trade that had roll down, it had a positive coupon, and it was very consistently negatively correlated to the stock market. The correlation between, let's say, the TLT and the S&P for 10 odd years was probably about minus 45%. I just looked, the 3-month realized correlation between the TLT and S&P is positive 36%. The bond market did not do well during the tariff tantrum, as Corey Hofstein likes to call it. And so we should be on the lookout for the types of things that happened in that short period of time. A second one was gold. Gold did incredibly well during that period. It did well before that period. It did well in 2024. And so, you've got a series of asset price movements that you can draw on from this recent period that I think we're supposed to, just have it at the ready in case it kicks back up.
So normally when the stock market declines or definitely crashes, the bond market rallies. So bond prices up, yields down, and often the dollar rallies as well. In April, the tariff tantrum, neither of that happened. The stock sold off, bonds sold off, and the dollar sold off, which really was quite something. What have you made of those correlations? And what's your general view of the bond market and the US dollar?
Yeah, so there's this old saying, I think it's attributed to Stanley Druckenmiller. He says, the best economist I know is the stock market. And it's a nod towards the pricing of things that when money is on the line, you get good information that's embedded in prices. And I like to say that the options market is an even better economist. And I would add correlations to that as well. So I just spend my time really trying to observe the movement of asset prices and also the co-movement of asset prices. And one of the signatures of the tariff tantrum was the sell-off in the dollar amidst a weakening of the back end of the yield curve. Terrible, right? It's a Liz Truss sort of 2022 period of the gilt crisis, right? Now, again, I'm not in any way comparing the U.S. to the UK, where the reserve currency, it's not going away, but you just don't want to see your currency fading as your rates rise. That's a weird dynamic, and as the VIX rises. So a lot of the things that I was spending time on was trying to isolate those periods where VIX up, rates up, dollar down. Not a lot of precedent for that at all. So we're supposed to keep an eye on that. And, I think sadly, we've done a lot of damage to the credibility of USA Inc. This is not a partisan comment. The Democrats have, done this as well. The expansion of the debt amidst a very low unemployment rate, a sky high stock market, and pretty strong economic growth. It's an addiction at this point. And this recent bill, the expansion of the debt ceiling by $5 trillion, it's going to be 2.5 years before we're revisiting this, and we'll be at 41 trillion. It's a certainty. There's just no formula for trying to get our arms around the debt. It's very politically unpopular. And again, it's not to be the sky is falling. It's just to observe that this is a very intractable problem. And so I really want to look at again, this tariff tantrum and say, okay, there was a period where rates were rising and the VIX was rising. Those types of things are very bad, right? That's a very bad dynamic. And so just keep an eye on it. Keep an eye on these correlations. Again, dollar rates and the S&P, and look for days, when they all move in a certain direction, i.e. dollar down, rates up, VIX up, and ask yourself what's going on there, right? So I like to look at those and try to see whether those are providing me with any early warning signs. Obviously, the dollar's been weak, but it's been weak amidst a rising S&P. That's okay. We'll kind of take that at least for now, but it's something we should definitely keep an eye on.
And the dollar has been weak even as the stock market has been rising. The bond market also is on a little bit of shaky legs. So the deficit is going to get bigger and bigger, and it seems to be a bipartisan consensus in DC to that the deficit it's not a problem. They say it's a problem, but they're based on their actions, not their words. They don't think it's a problem. So okay, ergo there's going to be more debt, more borrowing. So bond yields, the prices should go down, the yields should go up. Okay, but what about looking at the correlation? Like since the 1980s, debt has only grown while yields have only gone down, really. So there isn't that much of a correlation, even though fundamentally there should be. And also, yeah, just tell us your view about the 10-year being the risk asset, not the stock market, as well as your view on bonds, Dean. Because do you really think the 10-year is going to go to 6%, 7%? You don't think that insurance companies are just going to be, and banks are just going to be buying that every single day?
So I would say, first to your point about if you try to create some sort of scatter plot that looked at yields versus debt to GDP ratios, things like that, it's just going to show you nothing. And I can say, for sure, having studied the Eurozone sovereign debt crisis quite closely, Mario Draghi came in there and by the middle of 2020, 2012, had told you, that he's got his arms around it. The euro will never fail. Believe me, it will be enough. And effectively impose the central bank in a way that, created clearing prices, let's say, for Greek government debt, for Italian government debt, that are going to make any comparison of debt to GDP versus yield. It's not going to work. It's not going to look good, right? We had a period in 2020 when the 10-year yielded as low as, I want to say, it got down to 50 basis points amidst staggering debt levels still for the US. So those comparisons are not going to look good. What I would say is the debt structure of the US now versus 5 years ago, which was really a new leg up in terms of our debt stack. We had a health emergency. That was the last bipartisan initiative, was shelling out money. They were very worried, as they should have been. And so they were also borrowing that money at record low yields. Now the yields structure is so much different. The debt stack is higher and the yields are much, much higher as far as you can see. And so the interest costs, I think we're just supposed to be very concerned about the interest costs. Now, to your question around, are we going to see 6%, 7%? Totally hear you. It's a very liquid, deep market for which if folks could buy US government debt at 5%, 6%, boy, that's a great value proposition, assuming inflation isn't at 4%, and it's not. What I'm arguing is we need to be concerned about a risk off in the stock market that is bond market motivated. And this is where I would say the causality of the correlation between stocks and bonds gets flipped. So let me walk through it. In the post GFC era, a big risk off in the stock market, maybe it's the original debt ceiling showdown in 2011. Maybe it's the China risk off in 2015, which is coming up on its 10-year anniversary. The VIX event of 2018 is a little bit of a less good example, but for the most part, a big shock in the stock market is going to cause the bond market to rally. 2022, that causality flipped. It was the bond market that was the motivator of the stock market sell-off, right? So we saw this joint decline in the value of the bond market and the stock market. Yields up, stock market down. The difference was that this was a tightening cycle in 2022. The Fed was clearly behind the curve. You knew that the funds rate was going to head north by quite a bit, and the back end came up as well. And of course, inflation peaked at 9% in the middle of 2022. So stocks down, bonds down. What I'm saying is we need to be really on guard. And we saw a little bit of this. And we would have seen more had not Trump climbed down on April 9th, which is bond yields up. It feels uncontained. It feels volatile in the back end. We're trying to figure out what the clearing price is. And the stock market really doesn't like it, right? So I think it's not about predicting that bond yields are going to go to 7%. It's that a disruption to the back end. Perhaps it's an auction that doesn't go well. These are just not things that we should want in our public markets. And what I've argued is the US government bond market is one of the best assets we have in this country. It is global, it's liquid, it's deep, and we are abusing it. Our policymakers are abusing the privilege. And unfortunately, I think the reserve managers in other countries are onto it. But one of my best calls has been gold in 2024 and 2025, based on this idea that it's got the ability to almost act like a VIX during sometimes, not always, and you don't want to count on it. It's not a hedge. It's a great diversifying asset. It's up 25% this year with literally zero correlation to the S&P. You can't find anything like that in markets. There's no equivalent to that. And it really did its job during that kind of meltdown period where the bond market did not do its job. Now, I think in a real growth shock, if we ran into some big recession, I do think the long end is going to do what it's supposed to do. But it's just too volatile and unpredictable in the meantime, to really rely on it as a hedge. And you've got to think about other sources of diversification, things like gold, and I'll even put Bitcoin in there. Bitcoin's a lot of things. It's obviously very speculative, but there's some part, I think, of the investor psyche that Bitcoin, in addition to being a speculative risk asset, it also serves a purpose, which is gosh, I'm really not liking what I'm seeing from policymakers, from the folks in charge of the fiscal side in the US. And so Bitcoin, I think, a small allocation in the portfolio as well.
Totally get that argument about Bitcoin, but looking at the data, hasn't it historically been the case that Bitcoin trades basically like a triple levered NASDAQ? So, a lot of beta, 3 or 4 times beta to the S&P. Is the data showing anything different now?
I would say if you look at the correlations, you're correct. What I've run is I'll look at the 4% down moves in the S&P since 2015. And, there's a handful of them. We got a couple of them this year. We got a bunch in 2022. Obviously, COVID had a number of them. It's gigantic moves. And so if you look at the performance of gold on those days and then Bitcoin on those days, gold is on average kind of flat, maybe down a little bit. I think that's a fantastic property. I care about the down days, right? And so for gold to hang in there on a conditional basis is fantastic. And you're right. Bitcoin, if we just look at the performance of Bitcoin on just that subset of 4% down days, it's down like 5%. But it also has days when it rockets higher by 5% out of nowhere, right? Having nothing to do with the S&P. So what I would say about the distribution of returns on Bitcoin, and for me personally, I know Bitcoin's been around since 2010. I don't really look at anything before 2017. It just wasn't big enough as an asset class. But since 2017, what you've got is, again, very different from the S&P, where the lion's share of the volatility in the S&P comes from the down days. Stocks are a escalator up, elevator down. That's the asset class, right? They go up slowly and down fast. Bitcoin does both. It can go down fast for sure, and we should respect that, and we should own as much as the performance of that tells us. But we also have gotten to enjoy these big up shocks. And the up shocks are not on days when the triple Q goes up
Hmm.
5%. They are random sometimes. And what's got me really interested right now on Bitcoin, again, back to realize vol rules the world, there is a Bitcoin edition of that too. The financial laws of gravity and options are when realized vol goes down, options are just worth less. They're worth less money. The marginal price setter of the option is responding to realized vol. When realized vol isn't high, the hedger, the guy that's trading the delta back and forth, they just can't make enough money to sustain option premiums. So even in Bitcoin, as realized vol has come down into the mid 20s and 30s, which is really low for Bitcoin, that's over the last 2 months. It's brought implied vol, especially on short dated options, really low. So you could buy 1 month options at 37 implied vol, 38 implied vol. That is historically one of the lowest levels we've ever seen. What I find very interesting about that is we've consolidated right at this 108 to 110 level. Now, historically, when Bitcoin has gotten to a new breakout level, once it finds a way to punch through, it can really get to a new high level. And now it hasn't yet. We've been really trending right around this 108, 110 level. But I find it super interesting that the market gives you an opportunity to buy calls and call spreads at historically extremely low levels when the history says that if we do get through 110, it could be a little bit of an off to the races period.
That is really interesting. So calls on Bitcoin are very cheap, even though we're at all-time highs, because realized volatility has been cheap. So implied is cheap as well. And yeah, just tell us historically the volatility of Bitcoin starting in 2017. 2013 is not relevant. And I guess maybe over time the volatility of Bitcoin is going to go down and down and down. So maybe it's less relevant. And also, what are you thinking about longer dated options on Bitcoin? Because if the Bitcoin vol is really cheap, the way to really lock it in and get that Vega is longer dated options, right?
So before the Bitcoin ETFs came out, and before options on the Bitcoin ETFs came out, there have been other platforms that have traded options, just not in the US. And so there is price history. And Bitcoin vol has been as low as 30, it's been as high as 100 plus. And you make a good point, which is the maturation of the asset class is naturally going to lead to lower and lower vol over time. I'll give you, an example. We're kind of on the 25th anniversary of the tech bust, right? 2000 is when the tech bubble really burst, right around this time. And the triple Q implied vol was in the 70s, and it's gone all the way down to the 20s and 30s now, right? As tech stocks have matured. And I think you can make the same argument for Bitcoin. It's a new asset class. People don't understand it as well. And when options on Bitcoin were launched in November of last year, I was looking at the long dated options, kind of 1.5 and 2 year options, and they were in the mid 60s, maybe even 70. And one of my calls was, that's got nowhere to go but down. That's a short. Now that has come down. That's more in the kind of upper 40s now. It probably still has room to come down. But the short dated options in the mid to high 30s, those are very interesting to me. Again, on the buy side, your point was that the options they're both cheap and expensive at the same time. They are cheap to the history of implied vol on Bitcoin. I told you that mid to upper 30s, that's very low for Bitcoin. But they are expensive relative to the recently realized level of vol, which is more like mid 20s to 30. So an option could be both expensive in terms of how it's carrying, but cheap to its own history of implied vol. I like buying cheap to the history. One of my sort of just core views on mistakes that investors make, again, back to realized vol just dominating pricing, is that because realized vol, when it gets really low, it makes options very hard to hold. It drives implied vol down, and it nominally cheapens the option. I think that can create, some interesting opportunities. The thing about Bitcoin vol that is totally unique, it's totally different from S&P vol, is that as Bitcoin rises, its implied vol can rise. There's never a circumstance in the S&P where over a 6-month period the S&P is higher and the VIX is a bunch higher. It just doesn't work that way. In Bitcoin, we have this stock up, vol up characteristic, which I think is a fascinating and very new phenomenon. You don't see it in very much in equity markets. You see it in crude oil. You could see it in gold. Commodities can do this, and digital assets, it's a thing as well.
So if you buy a super out of the money call on the S&P, you could realize that, and in Delta you're going to make a bunch of money, but in implied volatility terms you're not. Whereas in Bitcoin you could, like, theoretically you could buy a call on Bitcoin at 180,000 at a certain vol X, and if Bitcoin gets to that level, you make money on the delta, on the price appreciation, but then also on implied volatility you could go to 1.5x. That's interesting.
It's an incredible point. And one of, back to gold, some people call, gold and digital gold. Not really. They're really not all that similar, as we pointed out, in terms of their betas to the S&P or to the triple Q. Gold, as I said, is zero correlation to the market this year. Bitcoin's more like a zero point 0.4 in terms of its correlation. But they do have the stock up, vol up characteristic. And what I would say, just really quickly on that, in bringing gold in, the point you made is a really important one. You can buy these very far out of the money, very long dated options on gold. And so, for example, the December 375 call on the GLD. GLD is at 305. Is it going to get to 375 by December? Probably not. But can I make money along the way if I get some portion of the delta right and the market assigns a new and higher level to the implied vol? So that vol right now on that D375 call could be maybe 19. If the market decides, you know what, I don't like what I'm seeing in terms of budgetary restraint, fiscal restraint. I don't like what the bond market's doing. I'm just generally concerned. That's kind of what gold is an expression of, concern. And I take that 19 vol and I put it up to 25 or higher. That expands the price of the call option in and of itself. Forget about the delta part. So if you get the stock going up and the vol going up at the same time, those can be hugely additive. So it's the same thing for Bitcoin.
And of course, as longtime viewers know, Van Eck is a sponsor. So you mentioned those Bitcoin and gold ETFs. Here at Monetary Matters, we like LUNZ for gold, and we like HODL for Bitcoin. Dean, why is the Bitcoin volatility so low? Other than low realized volatility, are people selling calls against Bitcoin? Is this speculative frenetic activity moving out of Bitcoin ETFs and into the extremely speculative vehicles of so-called Bitcoin Treasury holding companies? Historically, there was only one, MicroStrategy, and now MicroStrategy appears to be the quote-unquote blue chip, because now there are like literally 50 of these Bitcoin Treasury companies that make MicroStrategy look like Apple. And I am not saying that MicroStrategy is Apple, by the way. What's going on there? And yeah, do you have a view, like, just of your study of financial crisis, like, what are the odds that this ends poorly for the median Bitcoin Treasury holding company?
So you had a couple of things there. One was this idea of, is there a lot of supply of optionality in Bitcoin? And the answer is potentially. There are overriding ETFs. You get paid a nice premium. It's not 70 vol, but it's hard to find a 45 vol. So the upside calls are more like 45 vol. So your overriding fund collects some nice income against an asset that doesn't pay a dividend. There are not just US ETFs. This is a global market for structures on Bitcoin, many of which sell vol. So the market is well supplied in terms of vol. That can be a part of it. I think we do spend a lot of time in markets on the sport of attribution. We're trying to figure out why things happened. You brought MSTR in. MSTR in that period, I will say from September to late November of last year, went through an incredibly frenetic period where it was an insane stock up, vol up episode. And the interaction between Bitcoin, MSTR, I like to call it the Michael Saylor sound machine. There's no better unpaid public relations expert than Michael Saylor. He was doing every bit of media. He's incredibly effective at instilling the fear of missing out in you. His verbiage is amazing. Listen, I'm a believer in Bitcoin, but not with the certainty that he is. I think the certainty he brings to it is a bit absurd. No one should be that certain about it. He has one quote I love. He says, "Only buy Bitcoin with money you can't afford to lose," which is an amazing turn of phrase. Beautiful. But the feedback loop between MSTR and the levered ETFs that are written on top of it. You have MSTX and MSTU. They have to buy two times. There is a tremendous amount of volume that they were superimposing on MSTR in a long delta fashion. Then these levered ETFs were said to have gotten into the options market, and they started buying options on MSTR. So you had this spiral of implied vol and spot on MSTR, where the options got to be 200 plus implied vol. It really upends all of your thinking about models like Black-Scholes when you get into vols that are 200 plus. It was a bit of a meme stock episode with GameStop, of Jan 2021. So all that's kind of died down. What do I think about Bitcoin treasury companies? Listen, there is global demand for this asset in a way that you have ETF companies, like Van Eck, that are sources of demand. They're an on ramp, right? I think one of the things that Bitcoin struggled with was the on ramp. How do you get your money into this thing? Now we have ETFs that make it so easy, so transparent, liquid, low cost. It's a fantastic way of. I'm not a person that believes in taking my money out of the US system. I do believe in Bitcoin as a representation of something. So, just like for me, gold, I'm happy to own a gold ETF. I don't need gold bars. I'm happy to own a Bitcoin ETF. I don't need a passcode, a password, and cold storage. And I think that's for the most part where people are going to wind up. And ETFs, like Van X, are making that super easy to do.
Dan, I didn't know you were so open minded on Bitcoin. I'm glad we're having this conversation. I'm going to do some full disclosure with you and the audience is that I actually, for a time, was short the double levered MicroStrategy ETF, and against it, I owned some Bitcoin calls, which I actually still own. And it worked out well on both sides of the trade. But I just want to share a word of caution, and I hope you agree with me, Dan. And if you don't, Dean, if you don't agree with me, I'm definitely going to have to hit the spreadsheets and hit the books again. But that these double levered products, particularly of a non-diversified asset, a single stock that is very volatile, over time there is tremendous variance drag. And can you explain for the audience Dean, what variance drag is? And also, I think variance drag is kind of fake for something like Apple or Microsoft, because if Microsoft goes up 1% and down 1%, technically, yes, it's slightly down overall, but ultimately the value of the company is going to be related to the earnings of the company. And there's no risk that Apple is going to go down 90% when the earnings go up 900%, for example, barring some crazy crisis that happens. But what about, I feel like when you have an asset that literally gives you the twice volatility, there is no fundamental. It's purely the leverage thing. So the variance drag there is real and substantial. And yeah, I mean, MicroStrategy is probably where it was in price now when I shorted MSTU, and MSTU is down 30%. And I expect that to continue.
Yeah, no, I think the term variance drag, some people even call it like a variance penalty. I'm not even sure that that's the right term. And effectively, what it describes is the difference between an arithmetic return and a geometric return. What does a levered ETF do? It's at the end, let's just say it's a two times. Now there's the T triple Q, which is 3X. There are some 3Xers, but let's just stay with two times. You have to deliver, come hell or high water, at the end of the day, 2X the daily return. And what happens is your notional value gets bigger and bigger. And it's a little bit like a trade in which if you went to a casino and you went to the blackjack table and you just kept doubling your bet every day, eventually you're going to be wrong, and you're going to lose a lot when you're wrong. That's one kind of part of it, where assets like MSTR or the ETFs, MSTU and MSTX, are very vulnerable to the inherent volatility of MSTR. As you mentioned, a two timer on Apple or Nvidia is probably not going to be that big a deal in terms of its underperformance. But when you get an asset that's realizing 100 vol, which MSTR was for an extended period of time last year, um, the way in which that two times imposes itself, and the fact that ultimately you're going to go up 10%, but then maybe down 10% or 20% even. You just run those. If you go up 20%, you have 120, and then you go down 20%. 20% of 120 is more than 20, right? I mean, that's just the way it works. And it's the same thing on the short side. I happen to have done some on the same thing. You observe the same, the same variance. We'll call it variance drag. These features are so well laid out in the prospectus. If you look at the MSTU prospectus, it's got a grid there. I think it's probably mandated by the SEC to include the variance drag grid, which it's going to show you that here are the underlying vol levels, here's time, and here's what you can expect in terms of the underperformance. It's a easy to simulate underperformance, and the more time and higher the vol, the more the underperformance. It's just a fact. That's just how it works. No one would do this trading strategy on a long-term basis. If you woke up in the morning and wanted, some leverage to MSTR, buy MSTU. You're going to get twice the leverage, right? I mean, it's like buying a share and on margin, it's getting some leverage. Sadly, though, people hold these things for an extended period of time and they suffer that drag. It's just not a way that a person would really contemplate a trading strategy over a period of time. I do think what's, important, you mentioned my little sayings. One of them is, this is not your father's ETF market. The SPYs and the triple Q, these are yesteryear products. So you've got so many new flavors. These levered products are imposing themselves in the same way that a short gamma trade imposes itself. And what that does is it's an amplifier. Let's just take, both the levered long and levered short on MSTR. If MSTR has a big up day, they both actually have to do the same thing. They have to buy. Both the inverse and the long have to buy on the same day. They're contributor. Yin and yang are written on the FXI. They're actually reasonably big, and they imposed themselves during that period. I want to say it was late last year. So you've got to just be mindful that financial products themselves can be contributors to the volatility environment. It's not just about news flow. It's not about the Fed and the economy. The products themselves matter too.
And yeah, yin and yang are interesting products. Dean, we would be remiss if I didn't ask you about put structures to protect downside that you see in the market. With the VIX at 16 and things very calm in the market, the stock at all-time highs, is now the time to put on some protective hedges? Because the time to put on hedges is definitely not Liberation Day. It's definitely not the day after Liberation Day. It's not, in March 2009. Exactly. It's before the crisis. So what are you advising clients now? Where are you seeing opportunities to protect some gains?
So I'll give you my very simple portfolio. First of all, the S&P, it's the best benchmark in the history of the world. It is really difficult to beat the S&P 500. Time and time again, this index has delivered a 2-ish Sharpe ratio for the last couple of years. That's unheard of. You don't have to get out of bed. It's liquid, it's transparent. So be long the S&P, be long some gold, be long a little bit of Bitcoin. I think these assets are different. I think that they protect against some wayward scenarios. And then from an explicit protection standpoint, and again, gold and Bitcoin in no way are explicit protection. They're just a little different. And I like different. But from an explicit protection standpoint, vol isn't exactly really cheap. We've talked about the premium of the implied vol to realized vol, but it's nominally low enough. And so what I say is be long the S&P and then be long some put spreads. Very basic, easy to get into, easy to get out of, very low transaction costs. I like doing things like 3-month, 5% out of the money, and then maybe 10 or 15% out of the money. Okay, so the 95 85 or 95.80 put spread even, maybe even 20% out of the money. And that's going to cost you a little more than a percent, maybe 1.3%. I just feel like being long the market and then being willing to absorb a 1.3% loss for the protection, that's pretty good rainy day insurance against a market that's, at an all-time high. I'd also say, look, there's obviously it's a very top-heavy market. Nvidia just passed 4 trillion. Microsoft's on the doorstep of it. Same thing. These are very low realized vol assets, and the puts and put spreads on those stocks that are at all-time highs also really worth. If you're in the single stock land, and most people have that type of exposure, not a bad time to think about a little bit of rainy day insurance. The market's kind of handing it to you.
And where are you finding the cheapest rainy day insurance on the time spread? You said 5% out of the money, 3 months. What about further out of the money? How is skew? I know, like, going into Liberation Day and a few days after Liberation Day, skew was not that crazy, so it wasn't like it was pricing extremely negative outcomes, tail risk outcomes. Is that still the case? How does skew now compare to historical?
Kind of middle of the road.
Okay.
It's not a screaming, hey, you're supposed to do this because you're collecting a ton of premium for the 85 or 80 put that you sell. It's fair. And what I would say about the S&P vol surface, it's one of the most trafficked surfaces around. Maybe that in the U.S. government bond vol surface. There's 0 days to expiration, and there's 10 years to expiration, and every strike in between. So across time and across strike, there is interest and there's price discovery. You're not going to get ripped off, and you're not going to rip someone else off being in this market. It's a very well governed surface. So it's middle of the road. I just like having a little bit of rainy day insurance, only because the S&P just keeps going up, right? So for an asset that goes up this much, to pay away 1.5% every quarter, it's easily more than outstripping that. Now, I would say in the world of money management, where underperforming the benchmark by 1% is a big deal, look, that's a constraint. That's a real thing, right? The benchmark hugging is a very real thing in our industry. I don't really think about it that way. I just think you've got this asset that continues to run. Protection seems pretty reasonable. I'm not betting on a tail outcome. So I'm selling the 80 put and buying the 95. A real tail risk trade might be just buying the 80 put. I don't think you really have to do that right now. I like striking it higher and then using the premium I get for selling the 80 to offset some of the 95 that I buy.
Dean, final question for you. Give us one of your favorite pithy sayings that you didn't mention at the beginning.
There's an old saying, fear of missing out, FOMO. And for me, in our industry, it's ROMO, risk of missing out. And I just find that not participating in the upside of the market from an industry standpoint, you become very irrelevant very quickly if you're not delivering the goods. And what we wind up with time and time again is a market that gets in over its skis because the S&P is such a draw. If people, let's look at April 9th. Trump effectively backs down, and people see the S&P going up, the triple Q going up, and they go, oh my God, the risk of me underperforming, even if I remain bearish, the risk of underperforming is basically a business risk for me. So that's the risk of missing out. And so the market tends to chase itself, right? Fund managers chase the S&P because they are vulnerable to the risk of missing out.
Dean, thank you so much for coming on. You yourself have an amazing podcast called the Alpha Exchange Podcast, and people can find that on Twitter at alpha_x_LLC. Just tell us, what have you got cooking up at Macro Risk Advisors, as well as the things you're excited about for Alpha Exchange this summer?
Yeah, I mean, at MRA, we're in a business that's been around for a long time, which is deliver content, thought process, try to cover clients, institutional clients in a customized way, help them think through what is a very complicated risk environment. And the specialty is in options. I find that people spend 99% of their time on the risk on side of the portfolio. And when they have to think about the risk off side, i.e., the protection side, they don't have a plan, they don't have a budget, and I see consistent mistakes made. So we try to bring a sense of order to budgeting for and thinking through the hedging side of the portfolio and just basically thinking about how to use optionality in the portfolio.
Indeed, because you talked about puts. How are you assessing like the owning the S&P versus owning calls on the S&P? You talked about the relative attractiveness of puts, but what about calls?
Similar sort of setup. It's pretty middle of the road. We talked about the 5% out of the money call, a put. The 5% out of the money call out 3 months is about a 13 vol. Not terrible. It's a reasonably low cost call, but it's, as you mentioned, if the S&P rallies 5%, it's probably done so in a slow, steady way. And so it could be the case that you rally right to your strike, but not beyond it. Right. So it's pretty fair, the 5% out of the money call.
Thanks, Dean. Thanks, everyone, for watching. A reminder to check out Monetary Matters on Apple Podcasts and Spotify and leave a rating and review. It really helps the show. Also, subscribe to the Monetary Matters Network on YouTube. Until next time.
Thank you. Just close the door.